Okay. Looks like we've got people coming in. We've still got a few more, but we'll get started so we can make sure that we get Lakshmi as much time as we can give him. So today, just happy to have Lakshmi, who's going to present his paper with Joao and Bernardo. Um, I'll give a brief introduction on him, and then we can get into the green mortgages paper he's going to present. So Lakshmi is an assistant professor of finance at the London Business School. His research interests lie in the area of empirical corporate finance, which includes corporate governance, entrepreneurship, financial intermediation, and law and finance. His research has won several awards, including the USC Marshall School of Business Tref's Award at the Western Finance Meetings. His work has been featured in numerous publications, such as the Financial Express, Forbes, Oxford Business Law, and the World Bank. He graduated with a PhD in finance from Hong Kong University of Science and Technology. And overall, I really enjoy Lakshmi's research. A lot of cool and interesting projects he's working on, so we're very excited to have him present. You'll notice in the chat, we'll post some messages and some updates about upcoming schedule and things. Just to note, we'd love to have as many Q&A questions and chats. Lakshmi has said that he's happy to sort of try and answer questions throughout. So if you put a question in the chat, I'll try and flag it so we can address those, whether it's clarifying or some other interesting questions. And then we'll have some time at the end for Q&A as well. So thank you very much to everyone. I think with that, we'll just turn the time over to Lakshmi, and the floor is yours.
Brilliant. Thank you so much, Mike, for the invitation. And I'm glad I've been an outsider following, the series on and off. So it's a real pleasure to be here. And as Mike said, I kind of work broadly, across empirical corporate finance, but also I'm very much interested in trying to understand the role that private markets and public markets play in the green transition. And in that theme of work, this is one paper that I'm very much excited about and that we've been working on. So I would love to hear your thoughts on this. And as Mike mentioned, please feel free to ask questions. And I can't see the chat, so Mike, I would kind of request your help whenever you feel there's enough of a critical mass that to stop me, and I'll be happy to answer. So this is joint work with my colleagues Joao and Bernardo, who's a PhD student entering into his fourth year. So to kind of give you a brief motivation, Joao and I have kind of other work that kind of started thinking about the efforts that are required for decarbonizing the real estate sector. And in that stream of work, this is kind of a follow-on paper where we really wanted to kind of understand what is the role of private markets. So just to kind of give you a brief motivation of how we are thinking about this question is, banks in general kind of, play a central role in terms of allocating capital in the economy, and they are going to be key to financing, many things, including ideas, but also towards, the transition to a net zero economy, right? You can take numbers, here's one number that's been often quoted, which is, that we need about 9.2 trillion per year. You add biodiversity and other investment needs, those are going to be, going to quadruple, if anything, right? So that brings in the focus of, capital allocation in the economy, and banks are kind of front and center in how it's going to be allocated alongside financial markets. And particular to the assets that they finance, residential real estate is particularly significant when we think about net zero economy and towards how much impact they have, both in terms of energy consumption and carbon emission. Just to give you some number, the International Energy Agency estimates that, just the operations, forget about construction, just the operations of residential buildings contributes about 22% of global energy consumption and about 17% of carbon emissions. And these numbers almost double if you also take into the construction part of the residential sector, right? So these are going to be fundamentally important aspects and avenues where if you are able to target decarbonization, you would potentially be able to see very large benefits in terms of reduction in CO2 emissions, if not more. However, at the same time, there is a burgeoning literature that has kind of highlighted that there are significant barriers to kind of financing energy efficiency improvements, with the idea being that unconditionally, if you invest in energy efficiency improvements, you would also see concomitant improvements in carbon emissions. And we've kind of seen that, especially in the real estate sector, through the lens of LED, if not energy efficient building materials. And much of this kind of academic literature and policy making has then kind of understood, what are these barriers, and those have led to significant motivation in the form of government intervention, either through direct subsidies, direct regulations, or regulations that are kind of focusing on providing indirect subsidies and affecting the allocation of capital towards this sector. What is less well known is the role of private markets, especially in the absence of regulatory mandates, on what are lenders going to do. And in this paper, we want to focus on one such aspect of offering, particular offering in the household credit markets, and those are referred to as green mortgages. If you're in the US, these are also referred to as energy efficient mortgages, which are also available. So these are the financial products that are offered by private market lenders absent any regulation in the economy, either through the banking sector or in terms of incentives that they would receive. So what are green mortgages? Green mortgages, and the term green in these mortgages refers to the energy efficiency of the underlying property being financed. And one can think of two broad motivations of why regulators or why private market might have incentives to offer this. One is on the one side, they could incentivize borrowers to own properties that are more environmentally friendly. On the other hand, you could also imagine a scenario where you want the existing stock of properties to improve their energy efficiency, and hence they might incentivize borrowers to purchase energy efficient properties and or retrofit existing ones such that you improve their impact on the economy. Now, we are going to focus on the United Kingdom, where I'll tell you that we have a broad strokes. We have the universe of product offerings, and there are certain features that will allow us to kind of disentangle very cleanly what we think is happening in terms of why lenders, absent regulation, are offering these products. Just to kind of give you a preview, these are kind of the products that are available on kind of the left-hand side. You can see Nationwide and Barclays are offering green mortgages, where they are kind of enticing customers and saying, hey, if you buy an energy efficient property, you can get a lower rate. So that's going to be one class of offerings of green mortgages, where they are going to convey to consumers that we're going to offer lower discount rates. On the right-hand side, you can see another version of green mortgages, which are offering a cash reward. So Kensington, for example, on the top right, is offering about £500 of reward for clients who are purchasing a property with high levels of energy efficiency, where these are characterized using energy performance certificate. And I'll talk a bit about, right? And this distinction is what we're going to highlight and try to capture in our data, where we will try to understand what are the different types of offers in green mortgages and what motivates in these lenders to provide them, right? So that's going to be fairly what we're trying to achieve is just to characterize and understand the magnitudes of financial benefits that lenders offer on green mortgages. And second, we will just try to understand absent regulation and financial and government intervention, why are lenders offering these green mortgages, right? And to understand this, we are going to rely on the near universe of mortgages on offer in the UK mortgage market. What I mean by mortgages on offer are these are going to be menus of contracts that is available on a daily basis to people. So if I go and want to look at a mortgage, I will look at this list of mortgages, and I will be able to pick one of these mortgages on offer. So this is the list that everybody sees in the UK economy. And then we would be able to compute the magnitude of these financial benefits, where I'm going to kind of show you that I'll be able to compare very similar products on a daily basis to then compare and quantify what is the magnitude of this benefit in terms of monetary amounts. And in terms of trying to understand what are the explanations behind why lenders are offering, we would consider potentially several mechanisms, the main ones being are lenders using the green label to differentiate their products and segment the market, which we're going to call as the customer acquisition story. Compare that to the most often belabored story, which is about lower financing risk, meaning that more energy efficient properties are less expensive to run and hence either have a higher collateral value or give the ability for the landlord or the homeowner to service debt better. We would also consider some other mechanisms, though with less granularity, where we would try to understand maybe banks are offering them because this allows them to package these in their green bond issuance, or whether lenders are offering them because they've committed voluntarily to the Net Zero Banking Alliance. So we are going to consider these explanations. In terms of the preview of the results, and I think I'll run out of time, what we're going to first show is that even absent regulation, these mortgages have been growing in prominence, so roughly from 10 to 15% during our sample period of roughly 16 months. If you tend to think about the two motivations that I raised, one is, are they incentivizing homeowners to improve properties by retrofitting versus are they incentivizing them to buy properties that are already energy efficient? What at least we see in our data is that 97% of the mortgages are being offered for that incentivize borrowers to buy properties that are already energy efficient as opposed to improving them to improving their energy efficiency. So 97% are being offered for properties that are already highly energy efficient and 3% for future improvements. And typically, just as I showed you as my motivation, there are going to be kind of two types of financial benefits. One is going to be preferential rate, meaning that they're going to offer a lower discount rate. And the second is going to be upfront cashback, where you're going to get a cashback at the time of signing the contract. What is interesting in the data is you see that these two contracts are being offered in such a fashion that they essentially line up very nicely with what we understand in household credit markets, is that the homeowner segment, which is liquidity constrained, they are being offered more contracts of cashback type, meaning that given that they are liquidity constrained and have a low discount factor, they're offered more of the upfront, £500 cashback products, or at least the menu that they see. And in terms of the investor segment, think of these as landlords. They are being shown, or they are being offered more of the menus that contain preferential rate, meaning they are being targeted for wealth saving, right? So that's kind of one of the key things that we kind of highlight in the paper, is essentially that lenders are using the understanding of borrower heterogeneity and are targeting essentially liquidity savings by featuring more of cashback contracts in the owner-occupied segment, while they do offer more of a discount rate as preferential rate menus in the investor segment. How large are these benefits? If we kind of, and here we don't take a view on what is the search model through which investors are looking for, borrowers are looking in terms of lenders. So we allow for both comparisons, one across lenders and second within lenders. So you may go and search across different types of lender, whether it be NatWest, Kensington, HSBC, or we allow for search and our model to accommodate the fact that even within HSBC, you may prefer green mortgages over non-green mortgages. So how does that compare? So when we look at the preferential rate, we find that across lenders, this is roughly 35 basis point. And when we annualize this for a typical loan, that's roughly about £700 in benefit. Now, instead, if I make these comparisons within lenders, so in my example of HSBC, if I compare this a green mortgage to a non-green mortgage, that roughly comes down from 35 basis points to about roughly 9 basis points, and that translates to about an annualized benefit of £180. And these numbers look very similar in both the owner-occupied and investor segment. Now, if I compare this preferential rate magnitudes to cashback magnitude, what we find is that they are similar both across and within lenders in terms of the probability of it being offered, but conditional on it being offered, the average annual equivalent cashback amount is roughly about £50 to £56 in general, right? So in general, both of them are offering benefits to the customers, but preferential rate is offering roughly about 4 times larger annualized equivalent gains compared to the cashback amount in general. And essentially, then products with preferential rates are providing larger financial benefits to customers. But just to remind you, both of them are indeed still providing customers amongst the menus that are being offered. Both cashback and preferential rate products both are offering financial benefits. It's just the extent of benefit is larger for preferential rate as opposed to cashback products. In terms of the potential explanations, what we do find evidence is we find evidence supporting the customer acquisition story, especially that pertains to the cashback-based products that are being offered. And the way we try to establish this is in several ways. One is we can very clearly show, because we have the exact menu and we have all the kind of features that the lenders care about, we can essentially distinguish between the fact that whether a certain menu or certain product is being offered to buyers and not remortgages. And why is that important is, unlike the US, but very much similar to many other economies in the world. Typical contract tends to be a dual rate contract, meaning that there is a fixed discount period for a 2 year or 5 years, and then you go back to the market rate, at which point you have to refinance. And essentially, there is a lot of work on this to show essentially that buyers tend to be a lot more sensitive to search and pricing at the beginning of when you're purchasing a property, whereas at the time of remortgaging, because you have to do a full property value assessment, they tend to stick to the same lender, right? And that creates nice heterogeneity in terms of understanding the incentives behind why lenders would want to offer this. And what we find is essentially that the cashback based product, those that are offering the cash amount upfront, they are offered only to buyers but not to remortgagers, with the consistent with the idea that lenders are targeting specifically to liquidity constrained home buyers, because at the time when you're purchasing a property, you're already putting a down payment, a deposit of 15%, and then you have to incur other costs such as solicitor costs, closing costs, etc. And essentially the value of that 500 pound through a lower discount factor is much higher than for remortgages, who are then just searching less among different lenders. The second thing we can also nicely show is that if you look at the financial constraints, because we observe the different features of the contract, we can also show that these contracts are tailored more towards owner-occupied, who are more constrained than investors. And second, that these are targeted towards new build properties, who are ex ante more energy efficient, but also they're more expensive, and other shared ownership schemes, which are essentially targeting financially constrained homeowners. Right? So all of this seems to suggest that lenders are kind of particularly careful in tailoring these contracts at the group level, such that they're able to kind of acquire new customers who presumably were not part of their portfolio before. What we don't find very strong evidence of is this story about lower financing risk. And here we kind of distinguish between two types of stories. One we call as the cash flow channel story, with the idea being that more energy efficient properties, given that they're more energy efficient, would have a lot more cash flow available to service debt, because you would have lower energy expenditures for running them. And here we exploit sharp increases in energy prices and interest rates in the economy to show that we don't see that these are being offered more in the economy around these times. These are two distinct set of tests that we do. The second is something we call as collateral channel, with the idea being that, as default risk kind of increases, maybe more energy efficient properties, are subject to less of a discount in those higher default risk states. And here, when we look at, whether the product or the magnitude of the financial benefits being offered varies by LTV ratio, which we think is a decent proxy in household credit markets, we don't see much by way of this. So this allows us to essentially rule out that potentially, this is not the case that lenders are offering these products because more energy efficient properties are indeed, have a lower financing risk. We do find some evidence, but now we have to kind of aggregate our data a little bit to a different level as compared to these two tests, where we look at, is it the case that green mortgage offerings are pooled together in a green bond issuance, such that lenders are benefiting from a lower cost of capital, and that lower cost of capital gets transmitted to these benefits, both either through cashback offerings or through preferential rate contracts. And we don't see any evidence. One, in the data, the green bond issuance is kind of very low in general. And second, the magnitude that, not just us, but other people who worked in this space have documented of 1 to 2 basis points, doesn't kind of roughly translate to the 9 basis point that I kind of showed you. But what we do see some evidence is that voluntary climate commitments, so banks that have signed up to the Net Zero Banking Alliance, are also more likely to offer green mortgages. Of course, that's going to correlate with size, but what we can definitely show is that voluntary commitments explain a lot more of the variation than size itself, and hence we think there is a reputational mechanism at play where banks who have voluntarily committed to this are offering these products in the market in order to potentially either benefit or keep their reputational incentives at bay. So that's kind of the kind of overview of the paper, and hopefully I'll get into the weeds of it, but I'll take a minute here and pause and see if there are any questions.
Yeah, actually, I wanted to ask you a sort of a clarifying question,
Yeah.
Lakshmi. I can't tell for sure, but I'm trying to figure out, like, are you able to disentangle whether this is about like a real sort of preference for green? Or if this is about like energy efficient homes are really just like cheaper and better to run. Like, I don't know if we care which one it is, right? If it's just better and more efficient to be sort of a greener home, that's a good signal as well. But I'm trying to figure out whether we can disentangle like a technology channel versus sort of a green preference channel, or if that's not something you're going to get at.
Okay, so we can't disentangle between the two, but what I can specifically rule out is that if green efficient, if energy efficiency or the product offerings of green mortgages are related to greenness, or the cash flow channel as we call it, that I can certainly rule out, because if it's the case that green properties are more efficient to run and lenders value this because now I can service debt better, I should see that when energy prices are through the roof, they should start offering more of this. Right. And also when interest rates in the economy are kind of, through the roof, suddenly, you should see this. So I can certainly, in some sense, be comfortable in saying that it doesn't seem like that is the explanation. And we are happy with the preferences story, in the sense that that preferences story is essentially telling you that to the extent that borrowers care about a certain feature in the economy, today it happens to be green, it could be anything else tomorrow, lenders can potentially use that in a competitive market to kind of segment customers and offer them menus. I think that's something we can do, but I can't I will not have this story that pits preferences over efficiency. I can certainly rule out efficiency, but I cannot say much on what drives the preferences and whether preferences change. But preferences are important for market segmentation. Is something I can certainly establish through what I can rule out.
Gotcha. Okay. I'll ask one more question that I was wondering real quick. Just sort of, you mentioned this already, that there's sort of some distinctions between the U.S. market, perhaps, but this is quite similar to other markets. So, like, how much do we need to think about sort of the validity of this setting relative to the U.S. or some other kind of market structures for mortgages in other places?
Right. So I think it's a good question. So in the way at least we think about it, there are two ways to think about it. So while the mortgage structure itself might be different, what it helps us to do is rule out kind of these stories. But the broader takeaway of the fact that in private markets, absent regulation, lenders are going to segment the market is still something that's valid. And I think that is unconditional on the features of the mortgage contract itself. In this case, what it helps us to do is to say, well, oh, do lenders really kind of care about, say, financing risk versus something else? That is something we can rule out with the setting of the mortgage market. But the broader idea that they're going to use, absent regulation, the fact that investors care about, or borrowers care about a certain feature, and they're going to tailor products, I think is a generalizable aspect of this feature. And what I just want to reiterate is that the specific features of the UK market allows us to distinguish, as you kind of rightly asked at the beginning, which is the preference versus gain efficiency story. That's something we can kind of say a little bit about. But I think overall the main takeaway that market segmentation through product design is a general feature that should go beyond just the UK market.
Sure. I'll mention one other point that someone put up in the chat. They said, I recommend checking IFC's market accelerator for green construction, which they say is supported by the UK government's DSNZ. Just sort of I think there's some international evidence that it sounds like might be consistent with what sort of you're pointing out, but I'll forward that to you as well. But just another sort of, I think there's some other evidence suggesting that internationally this could also be consistent from their perspective as well.
Wonderful. I was not aware of it. Thank you.
Yeah.
Okay. So let me move on then. So let me just give you a brief details about the market structure and then the data. So typically the UK mortgage market works like a mortgage supermarket, with the idea being that you kind of walk into a supermarket. There are many different products on offer each day by different lenders with different characteristics. One thing I like to highlight is that legally it's not allowed to tailor product features at the individual level. So whatever is the group level feature, and howsoever fine it is, we observe all those relevant features in the data. And hence, a typical dual rate mortgage contract in the UK has an initial period of discounted and fixed rate. Typically, it tends to be 2 years or 5 years, at which point you then refinance, and most borrowers do this. Our data comes from Moneyfacts group, where we have the universe of mortgages on offer in the UK. It contains very detailed information of what market segment they're targeting, the product characteristic, the lender identity. We have roughly about 180,000 unique mortgage contracts, which translate to roughly about 4 million product offerings, of which about half of them are green observations. And we're going to cover a sample period of 16 months between 2022 and 2023. So the first thing is, how we have to we kind of dive deep into what are the financial benefits on the green mortgages, and to do that, we're going to estimate the following specifications. So think of the outcome as either the cashback or interest rate, and then we're going to compare the following. So because everything is at the daily offering level, we observe all the menu. We're going to compare a product that is labeled as green, that's identified as green, compared to a non-green product within the same product type, borrower type, and day. What do we mean by borrower type? So each product type is going to be an interest rate type. So think of fixed versus variable rate, an initial interest rate period, a fixation period of 2 years or 5 years, the maximum LTV that is allowed on this particular menu. So say 75% or 80%. So each product type then becomes a fixed rate, 2-year, 80%. 2 years of variable rate, 5 years, 80%. So each of that becomes a unit of product type. And this is kind of important because mortgage contracts can vary within these buckets. Just to remind you, as I mentioned, it cannot be tailored to individual characteristics. So these are kind of the buckets that are very relevant, and hence we control for it. In terms of borrower type, it's first-time borrowers, second-time buyers, remortgagers, and a combination thereof. So we can also identify that, and whether the products are offered on the same day, right? So essentially, what you want to think about this fixed effects is we are going to compare somebody who is looking for a fixed rate contract for 2-year period, has an 80% LTV, is a first-time buyer on say 27th of September 2026. Right, so that's what we are going to do, and on this day we are going to compare all the products that are offered, that are labeled as green versus those that are. And then we are going to allow this fixed effects to vary with lender and without lender. So we're going to have a fourth interaction with lender fixed effects. That is then going to capture that whether within HSBC, I'm going to compare a green mortgage to a non-green mortgage, right? So that's kind of the idea. If not, if you don't have the lender fixed effects, then we are comparing mortgages that are being offered across HSBC and NatWest more generally, right? Because we don't want to take a particular view on what the search process is. We allow for this additional flexibility. And essentially, the coefficient beta is then going to capture the relative difference between the two on a daily basis. So what do we find? So here we are focusing on green products that are explicitly stating preferential rates. So you might be concerned that maybe salience is an issue, in that people don't know about this, or maybe they're missing out on something. So we have different versions of the paper, but what I'm presenting here is those products that explicitly state that preferential rate is a benefit, right? And we are going to treat the two market segments separately: owner-occupied and investor segment. So think investor segment being landlord segment, owner-occupied being you're buying the house to live there, right? So we're going to start from, most of the tables are going to look like this, where the first 3 columns are going to focus within the subset of products that are targeted to the owner-occupied sector, and 4, 5, 6, the last 3 columns towards the investor segment. Here, the dependent variable is the initial rate that is being offered, and we're going to compare the coefficient on green, right? So as we move from column 1 to 3, we're going to saturate the fixed effect. So my 35 basis point number that I mentioned was from column 2, and then when I move from column 2 to column 3, you see that the green products offered on the same day across these borrower, product, day type, lender type offer a 9 basis point discount, and that 9 basis point discount you compare to column 6 is about roughly 11 basis point discount, right? We can do this for, as I said, taking out the salience part, etc. The numbers are going to look slightly smaller, but still statistically significant. We can also do this for larger lenders, which are typically referred to as high street lenders, and classified using the fact that they are top 7 based on size. More generally, it doesn't really matter. You see this through and through that lenders are offering these products across the board. If I then
Lakshmi,
look at, yeah.
A couple of questions. I don't know if you want to answer these or save them. I can read them for you. So a question from Andreas. He said, lender preferences might not change product supply immediately, such as after an energy price shock. They think maybe internal management processes could take years. What are your thoughts on that as you're identifying this?
So we are going to tell you, we will be able to show you different ways of kind of thinking about it. Maybe the preferences don't change over a certain period of time, but we do show that consistent with their recognition of voluntary commitments, you do see these changes happening. So in that sense, if we think that they're responding to one situation but not the other, then it's slightly incongruous within the lender. But we can show that it doesn't move here, but it moves in an object where we think it should move. So we think in that sense, it's not as inertia based as we would like to think. So I think this is internally consistent in that sense. Yeah.
Gotcha. One more question here from Nurai. They said, I'm wondering if you have access to all different mortgage options offered to a home buyer, and then the choice of this home buyer among these options, or you just observe the mortgage given to a home buyer, which could be the result of a bank's offerings to home buyer or their choice among different options.
Okay, that's a good point. So let me just clarify. Everything we do in this paper is offering. So these are the entire universe of what is being offered. We don't have originations, meaning that I can't tell you whether this offer is being taken out, right? So what I can show you is all the offer that the bank is providing to homeowners, to remortgagers, second-time buyers, first-time buyers. I can see everything, right? And this is the same pool that I picked, my mortgage from as well, right? So that's the universe that we have. What I cannot show you is what happens in terms of this next stage, where this menu gets matched with the origination. Because at the origination level, there is no green identifier, and as you will appreciate over time, this is a very granular set of fixed effects, and hence that means for every green product, there's also a non-green product that looks almost similar, and hence matching it to the official origination data may give us very many false positives and false negatives. So what I will be able to show you, just to reiterate and belabor, is everything that is an offering that is available on the product on the day. And this is the universe of what anybody would see on this day, as opposed to origination.
I have one more question. If
yeah, sure, please.
Okay, so Nimra asked the question, so how does the model's reliance on these lender fixed effects and product borrower day fixed effects impact the generalizability of the estimated green premium beta to broader mortgage markets? So I think they're sort of wondering, if you're soaking up so much information, is it capturing something very specific, or is it still generalizable as you thought before?
I mean, I would argue that this is much more generalizable with having these set of fixed effects than otherwise. Because I mean, if I were to show you without these fixed effects, then you might say, well, hey, these differences could be explained by so many other things. Just to point out, if I look at basically say column 2 versus column 3, you see that roughly about 65% of the variation in the interest rate is being explained just by product, by borrower, by day fixed effects. And I think that still tells you that there's still a lot of variation that exists in the data. And then when I go there with lender fixed effects, you still see that even after presumably the most granular set of fixed effect, there's still 5% of the variation that I cannot explain. That still tells you that lenders are trying to figure out that level of heterogeneity. And what we think is essentially by tagging on a green label, it creates one more layer of variation that lenders can essentially exploit in competitive mortgage market. They're always trying to, and let me just reiterate this point as well, that because they can't tailor the product at the individual level, they're trying to figure out, price discrimination at the level of a group. And this is kind of just saying that tacking on a green label allows them to segment the market, presumably due to the fact that certain investor group or certain borrower types have a preference for green, right? And I think that's safe to say. So I think if anything, I would say this makes it more generalizable than less so. If I were to show you aggregate trends and then say, hey, you see this difference is 100 basis points or something.
Perfect.
Okay, so I have about 15 minutes. Is it true?
Yeah, you've got about 15 minutes or so. Yeah.
Okay, brilliant.
And you can, I mean, since we're answering questions now too, you could take a little more. So.
Okay, no worries. I mean, I guess if everybody got the story, then we're all fine. And this is just showing numbers. Okay, so that was initial rate. Now the second contractual feature I mentioned was cashback. So here I'm looking at products that are explicitly stating cashback as a benefit. And first, I'm going to look at the probability that a cashback is being offered as a function of whether it's a green label or not. And then kind of conditional on cashback, I'm going to tell you what is the cashback amount. I showed you an example of £500, but that is, a hand-picked one. So, you might be wondering what's the average in the data, right? So I'm going to compare, things in column 2 and column 3 as before in 5 and 6 subsequently. So in column 2 and 3, this is basically telling you that green products have a higher likelihood of offering a cash back on their product, so extensive margin, and conditional on them being offered, you see that roughly across lenders it's going to be about £250, whereas within lender, if you're comparing green versus non-green, green products are going to have an upfront cashback of roughly about £211, right? So that's kind of basically saying that green products are more likely to have a cashback offer. And that magnitude is roughly about 250 if you're comparing across lenders versus 211 if you're comparing within lender across products. So now I need to kind of annualize this because this is not comparable. So a typical loan amount is roughly about £200,000 in the UK. Let's consider a 5-year fixation period, meaning during this period, the initial rate is roughly about 5.26% in the data. And then we will convert this into an NPV calculation of annual equivalent benefits for both type of products. And here I'm going to show you both all lenders and top 7 lenders, but let's focus on panel A, which is on all lenders. So basically, the dark green bars are preferential rate and the light green bars are cashback. So going back to the 35 basis point, that roughly translates to about £700 when you compare across lenders, and the equivalent amount for cashback is roughly £56. And when you do this comparison of that 9 basis point, that converts to an annual equivalent preferential rate of £180, whereas within lender it's £49. Right? I want to again reiterate one more thing. Is that across both type of products, borrowers are still benefiting, right? Even if they pick off the menu cashback, they would still get a benefit. If they pick preferential rate contracts, they're going to pick, they will still benefit. It's just that the benefit that's been provided by the preferential rate contracts are larger. But as a homeowner, what you end up seeing is that 3 out of 4 contracts tend to be cashback. Whereas if you're an investor, 3 out of 4 tend to be a preferential rate contract. That's what we want to say. And these numbers are kind of still significant when we look at top 7 lenders, who you can presumably think are correlated with size, right? So that's kind of something I wanted to mention. Then you might be wondering, hey, is it the case that if they're offering these features upfront, are they substituting for it later, right? So maybe you might be wondering that, maybe the estimated benefits are offset by higher fees that they're going to charge, right? So when you think about, a mortgage product, you have interest rates, you have origination fees, and then you have upfront cashback. And then after kind of the initial period of discounting, you have the reversion rate where you go back to the market rate. And hence you might be wondering, hey, maybe these are features that are front loaded, and hence there might be something that might be happening to other parts of the feature. And the good thing is, because we see the entire contract, we can kind of tell you what's happening. And what we do find is we don't see that on these green products that there are any statistically significant differences in either a higher fees or a reversion rate that's later when these individuals might refinance, right? So we don't see any effect there. And as I said, this is robust to kind of, doing this exercise, not just at the lender level, but based on ultimate, ownership at the financial group, etc., suggesting that indeed lenders are kind of offering these genuine benefits on the green mortgages to a greater extent at preferential rate and to a lesser extent at cashback, but nonetheless a benefit for borrowers in picking the menu of green amongst the menu of contracts. So that's kind of the first part of the paper. In the second part, we will then spend some time on thinking about why do lenders offer green mortgages. And the first thing we're going to start with is about the customer acquisition. So just kind of let me remind you, this is where the feature of the UK mortgage market contracts kind of are helpful in disentangling some of this. So a typical home purchase decision kind of say happens at time t equals to 0. An initial period of 2 years to 5 years is kind of the discounted period, after which about 2/3 of the people remortgage. And the remaining kind of either repay their mortgage or go back on the higher reversion rate, depends on what's happening in the macroeconomy. Of the two-thirds that remortgage, roughly, about 70% of them tend to mortgage with the same lender. And the reason for that is if you remortgage with the same lender, you don't have to do affordability assessment and you don't have to do property valuation again. So that process is called product transfer if there's no equity extraction. And essentially the key idea being that continuing with the same lender makes your life a lot easier. Whereas 29% of the individuals or households tend to switch lenders, and that triggers new affordability assessment. You have to provide your proof of income at that point in time and full property valuation, right? So typically in this chain, as you see, there is a distinction at the time of purchase. You have a lot of incentive to search for it, but typically, for many reasons that many different people have documented, at the time of remortgage, you want to stick to the same lender to avoid kind of these additional costs. And hence that allows us to then hypothesize whether we think cashback should be offered, cashback product should be offered differentially at the time of home purchase versus remortgages, going back to some of the questions that we had earlier. And this is something, because of the offering, we can essentially see this very clearly in the data, and something we can use to disentangle between the stories. So what we do is essentially we look at the product characteristics and who it is being offered to. And then essentially what we can do is we can classify whether it's available only to buyers or it is available only to remortgagers. With the idea being that, if we really think that, they are trying to acquire new customer, then these lenders would essentially offer these green mortgages with cashback only offers at the time of purchase, at the time of buying, but not at the time of remortgaging, right? And essentially that's what we are trying to test here. And what we see, if you look at column 3, where we are essentially studying the interaction between the two, we see that indeed green products are much more likely to be offered to buyers only. And if we look at the corresponding column 6, we see that they're less likely to be offered to remortgages, right? So the menus that they see are very different at the time of purchase versus at the time of remortgaging. And that seems to be very much consistent in how lenders want to acquire. Now, one thing we also test is it the case that, green products are somewhat different from lender fixed effects, with the idea being that is it a general broader strategy of the lender to offer cashback? This is something we test here, and basically what we see here is that lenders who are offering cashback are also likely to do so for green products, as well as for non-green products, right? So cashback seems to be more of a lender strategy to acquire customers, and hence that's something that they tend to exploit differentially, such that they can acquire customer at the beginning of the house purchase chain, as opposed to in the middle, where they're kind of more certain of how and who they want to kind of pair up with, right? So that's something we can very nicely show, and seems to be consistent with their incentives to acquire customers. The second is the targeting of financial constrained borrowers. And as I mentioned, a typical house purchase requires you to put up in the homeowner segment at least about 10 to 15% of your LTV. You have to have your closing costs, etc. So that's quite significant. And hence, if lenders want to lock in these customers, then they would differentially target financially constrained customers more so than financially unconstrained customers. And therein we can also they can also kind of focus on cashback offers, because financially constrained customers or borrowers are more likely to have lower discount factors, something that's well established in the household credit literature more generally. And hence what we tend to do is, as a first test, we are going to basically look at the market segment itself. So it's safe to assume that owner-occupier, meaning people who are buying houses to live in, are more liquidity constrained than investors, which is also true because the typical loan to value ratio, typical deposit that you have to pay if you are buying for renting out your property as a landlord is about 25% compared to roughly about 10% on average for the owner occupier segment. And hence, when we look at the cashback is more likely to be offered in the owner occupier segment as opposed to the investor segment. So that's kind of the first piece of evidence. The second is, in the data, we can also observe whether or not the particular contract is available for new builds. So new builds are property that are newly built. So on the one hand, they're more energy efficient, but also they're more expensive. And hence, new builds tend to be something that we hypothesize could be under target by these lenders, especially for cashback contracts. And when we kind of look at an indicator for whether or not these green products are available to new builds, we do see that the propensity of cashback products among green to be offered to only available to new builds seems to be higher compared to other products, both green and non-green, that are cashback but not available to new builds, right? So that's kind of one piece of additional evidence on financial constraints, to the extent that new builds are, and we spend a lot of time in the paper kind of showing evidence that new builds are indeed more expensive, and that a lot more higher fraction of borrowers here tend to be first time buyers, and also young, who are limited, who typically follow the description of somebody who would be more financially constrained and would require to climb up the housing ladder. The second kind of proxy that we used is something called a shared ownership scheme, with the idea being that, as I mentioned, if you require 10% to be deposited at the time of initiating the loan, the mortgage contract, and you only have deposit of 5%, the shared ownership, the remaining 5% could either be facilitated by the government, who might allow you at who will lend you the money for the remaining 5%, and you have to pay rent or interest on it, and hence these are called shared ownership schemes, so that this is targeted towards people who are constrained and who want to afford a house. So in the data, we can also see whether these are exclusively being offered for shared ownership schemes, these products. And what we do see is that disproportionately, the propensity of these cashback products in the green mortgages also tend to tailor towards those who are on the shared ownership schemes more generally. And this doesn't really matter if we kind of compare all lenders or just the top 7 lenders, right? So this seems like a feature of the lender market design, where they're tailoring this particular aspect to financial constraints, such that the cashback is targeted towards more financially constrained borrowers, especially in the homeowner segment, as opposed to the landlord segment, who are less liquidity constrained. And then comes kind of, so that's kind of, we think is kind of a nice evidence that has presumably a lot more external validity, in that in the market, absent regulation, lenders are essentially segmenting the market in such a way that they can acquire new customers. What are the characteristics of these new customers? Of course, one fact is that they're looking for green, which could be preferences, but at the same time, they're also segmenting them based on their understanding of borrower heterogeneity, and particularly those who are liquidity constrained, and hence that we can proxy in our data using new builds and shared ownership. And then that seems to be something that we can very nicely show that in these competitive markets, the green label serves as a product differentiation tool. A common argument typically tends to be that, because these contracts are offered for more energy efficient properties, the two stories that often tend to come up is, one, that they're less expensive to operate, and hence they will have a greater capacity to service debt. And here we exploit sharp changes in energy prices due to the Russia-Ukraine war that happened that started in February. And then in terms of kind of the long-term kind of shock that somebody had pointed out, saying, well, maybe changes in energy prices might be temporary. We kind of exploit another sudden and unanticipated mini budget announcement in the context of UK, which led to substantial increases in interest rate for a long period of time, roughly by about 100 basis points overnight. And across both of these tests, and I'll show you that we don't find much evidence that when these changes happen, both independently of energy prices or interest rate increases in the economy, we don't see that the volume of these contracts with these differential features differs across segments or within lenders more generally. And the second is the collateral value channel, with the idea being that greener properties are subject and more resilient to brown discounts. And there we look at LTV ratio as a proxy for default risk, and we don't find any gradient in terms of how interest rates or cashback changes as a function of the distribution of LTV in the economy. And this allows us to then conclude that maybe we don't see all else equal that borrowers seeking mortgages face some form of lower credit risk, or that lenders are kind of supplying these contracts with that aspect particularly in mind. But more so, the first kind of set of results that I showed you is that they essentially would like to segment the market and acquire these new customers who otherwise would not be part of their loan book. So energy prices, this is kind of the distribution. So energy prices went through the roof during the middle of our sample, and then they kind of came down back. And we exploit that. We have the data on a weekly frequency, and then we can interact this with any which way. And we don't find much evidence on both interest rate or in terms of the cash back. We can look at electricity price. We also did with gas prices. It doesn't really matter in terms of whatever we use. We don't find much evidence of this channel. You might be wondering, well, maybe there is, some notion that, energy efficiency is being priced as opposed to green. So there is this paper in Economic Journal by a few authors at the Bank of England that looked at whether or not there is lower interest rate on energy efficiency even before the notion of green and sustainability came in. So they look at a period of 2012 to 2017 in the UK. They combine mortgage originations with kind of energy efficiency of the properties, and they don't find any evidence that the pre-period there was any evidence that energy efficiency itself is priced in terms of initial rate, right? So that kind of provides us with additional at least support that presumably it's not about the cash flow channel. Even in periods where people did not care about it, you do not see much kind of happening. And in terms of the collateral value channel, we interact, the green label with LTV ratios. Again, we don't see much happening across the distribution. Again, we don't think that's what's happening in the data. So all of that was kind of, we could leverage everything at a very granular level. Then we consider a few other mechanisms that might be at play, some of which came up during several discussions. One of the most prominent arguments was that presumably there is, a lower cost of capital channel. So maybe what banks are doing is, they can bundle these green mortgages and then kind of sell it in the primary market, and hence, whatever is the cost of capital benefit that they would get in the green bond market in terms of the reduction in the yields, they would essentially transmit that to the borrowers. And we don't find any evidence of a relationship between green bond issuance and green mortgage offering. So we have the universe of green bonds from the Bloomberg fixed income database. The second was kind of the fact that lenders are doing this out of climate commitments that they had made, and here essentially we look at the Net Zero Banking Alliance, and we look at the signing of the lenders in our data, and then we look at whether or not the decision to offer and the volume of green mortgages that are being offered is reflected by the voluntary signing of these commitments with explicit targets. And what we do find is that green commitments are positively associated. So if you signed up for Net Zero Banking Alliance, that does seem to correlate positively with the propensity to offer and the volume of green mortgages that you offer in the owner-occupier segment per se. But given that these are at the lender level, they do correlate pretty much with size, even though the amount of variation that we can explain is a lot more at the lender level than by size. And that makes us think that it's presumably the voluntary commitment aspect and the reputational aspect that might be at play here, where lenders are motivated to offer these, given that they have made these commitments in public with explicit targets that focus on their lending portfolios more generally. So I think I'm out of time. So let me just kind of take a minute or two to just conclude. Hopefully, kind of I gave you a good sense of absent regulation and subsidies and mandates, private market lenders do offer green mortgages. Much of that tends to be focused on providing incentives to acquire already energy efficient properties, as opposed to incentivize them to make additional investments to improve these properties. There's significant heterogeneity. They tend to come in two forms and very distinct based on the market segment. So on the one side, they would tend to offer a menu of preferential rate that can vary between 9 to 35 basis points, depending on how do you search. You search within lender, across lender. And the other type being where they look at the liquidity constraints of the borrower and offer an upfront cash back. And that's roughly about 49 to 56 pounds on an annualized equivalent basis. What we do see is that in terms of why lenders are offering, we don't find support for credit risk, but if anything, we find evidence that lenders are using their knowledge of borrower heterogeneity to segment market by tacking on the green label and trying to attract new customers, especially who are liquidity constraints and financially constrained with a very low discount factor by offering them the menus with more cashback based products. There's also some evidence where we can say something about the reputational and strategic positioning by lenders who've signed up for voluntary commitments, but we don't find much evidence on the cost of capital through green bond issuance. So I'll stop here. Thank you so much for your time and questions. I'm happy to take more questions. I'm sure there are more questions than answers.
Yeah, thank you so much, Lakshmi. Really interesting paper. So if anyone has questions, we have maybe 4 minutes left. So if you want to put them in the Q&A or the chat, also if some of our PhD committee members, if they want to just unmute themselves, go ahead. I think Olympia's got a question already. So Olympia, you want to go ahead and ask?
Thank you. Thanks, Lakshmi, for the interesting presentation. I guess my point is again on the interpretation of this, especially in the perspective of the big role of cashbacks that we could tell. And I was wondering whether, although this is not a story about being able to select, let's say, less risky borrowers, whether this is instead a story of being able to better price risk. So regardless of the risk level, I see these cashbacks as a way to allow customers to essentially self-select and almost reveal the risk type, given that they will reveal that they are cash constrained in a way, and whether banks can gain from the ability to better price their risk, their probability of defaults, and so on, whether you have evidence in this perspective. Yeah, I guess that's my point.
So in terms of better risk pricing, because we're comparing within the same borrower type, right? So if anything, the story would be that financially constrained, if you think to the extent that that the risk pricing story should go on, either we should see that in the LTV cuts that we looked at, because that should go along this, or the fact that financially constrained would be the one who are more likely to kind of have higher LTV ratios and highly likely default. We don't kind of see that happening. If anything, they're being offered more of this, right? So it's actually going in the opposite direction. Which seems to suggest that if anything, this seems like more on customer acquisition than them repricing risk, because all the repricing risk would suggest that they should be charging them more. But if anything, we are seeing the opposite, which is that they're giving them more discounts so that they can attract them.
So I have
Yeah,
I have one more question here from one of our audience members. So said, why do lenders restrict these cashback offers to first-time buyers instead of to remortgagers? How does this affect the remortgaging rate? I guess my sort of follow-up on that from this good question from Nimra is like, do we view this behavior as sort of efficiently, sort of optimal or socially efficient, or is this really just about gaining customers and not thinking broader than that?
Yeah, good question. So let me clarify that. So given the fact that given that lenders, at least this is our interpretation, and I'm happy to hear a different version of it. Our interpretation is that given that we know most people exposed at the time of refinancing stick to the same lender, from a lender's perspective, in some sense, it's better to get them in the door when they're purchasing as opposed to remortgaging, right? And given that we know it's more costly for preferential rate than cashback rate, they don't offer that anyway, any which ways. And given that if 2/3 of the people are going to stick with the same lender, it's better to catch them, because then there are also other opportunities for lenders for cross-selling. Right. So it's not the case that you are kind of just operating on this. So in that sense, we think that once you are in the universe at the level of the home purchase, it opens up from a lender's perspective. Maybe it's optimal. We don't have anything to say about it on that dimension to have them at that place. Now, in terms of the social optimality, I think that question, if you kind of take a hat on and say, well, at the end of the day, are they incentivizing decarbonization? The answer is yes, right? Because to the extent that you're purchasing A and B properties and they're more energy efficient, they are, indeed, part of the decarbonization effort. Yes, you are. Are you alleviating constraints? Are you offering discounts? Yes, they are. It's just that the heterogeneity is what is interesting in that they seem to do it in a very cost efficient way in some sense.
Yeah.
At least
Gotcha.
in the designing of the product, right? That seems
Gotcha.
to be a clever way of doing it. So that's all I think we can say.
Gotcha. Well, I mean, I think we could ask questions all day. Very interesting paper, but I think we'll have to wrap up. Lakshmi, thank you very much. Wonderful paper. To all of our participants, our panelists, everyone, the questions, really excellent. I'll just make one more announcement that our next webinar is going to take place on April 30th when Qiping Zhu will, from UIC, Illinois Urbana-Champaign, she's going to present her paper, Temperature Adaptation and Local Industry Concentration. I think in the chat, we're going to post some registration information for those of you who want to register. Thanks again, everyone, for wonderful questions. Great paper today, and we'll see you guys next time. So thank you very much.
Thank you so much.